Hello, I'm Grace. Foreign exchange markets drew attention today as the $1 exchange rate showed a distinct downward trend. The sell-off of hedged foreign exchange by the National Pension Service, NPS, was identified as a primary factor, focusing interest on this development. The $1 closed at 1,526.51, down approximately 7 from the previous day. This price is considered among the lowest levels seen in recent months. Analysts attribute this to an immediate reflection of shifting market participant sentiment. Notably, the price dropped about 7 from yesterday's closing level of 1,534. This sharp decline is deeply connected to institutional investors adjusting their positions rather than simple market volatility. Given the NPS's historical focus on long-term stability over short-term volatility, this move appears exceptional. It stems from increased valuation losses on held dollar assets amid a recent strengthening of the won. The prevailing analysis suggests the sell-off was likely a risk management decision. Reports indicate the NPS hedges a significant portion of its dollar holdings. This scale is assessed to significantly impact market liquidity. Other institutions may be reviewing similar risk management strategies. If the won's strength persists, pension funds and insurance companies could also consider selling. Such chain selling by institutions may have accelerated the exchange rate drop. While the won has strengthened, its sustainability remains uncertain. Most analysts view this drop as a short-term adjustment. This is because U.S. Federal Reserve interest rate policy and domestic economic indicators remain unclear. In the short term, there are positive effects in stabilizing import prices. Lower import prices could ease consumer price inflation pressures. This may also positively influence the stability of gasoline and diesel prices. Despite oil price volatility, the stronger won can help mitigate price increases. However, structural issues exist that could burden export companies. We must be cautious about the potential weakening of export competitiveness. Tourism and overseas travelers can benefit from lower costs. This may also boost consumer sentiment in the short term. Yet, household debt issues remain unresolved, suggesting cautious consumption patterns will persist. Market predictions are always difficult, so unconditional optimism is unwise. Given the high volatility, close monitoring is necessary. Investors are advised to diversify assets with a long-term perspective rather than pursuing excessive leverage. Strategies that withstand exchange rate fluctuations are essential. It is premature to determine whether this is a technical correction or a structural shift. Future exchange rate trends will largely depend on global macroeconomic indicators and domestic policy changes. The influence of institutional investors on market sentiment should not be overlooked. We must closely monitor how long the strong won trend lasts and its economic impact. An investment approach prioritizing long-term asset stability over short-term gains is required. We must watch whether this drop is a temporary phenomenon or the start of a new economic order. This is a time for rational judgment amidst confusing market flows. Attention should be paid to upcoming economic data releases and central bank statements. Given the increased exchange rate volatility, investors require special caution. I'm Grace, thanks for watching.